In today's video, we're going to cover the 3 pillars of what makes a good investment. Just quickly, those 3 pillars are an understanding that stock price is tied to the earnings of a company. Second is truly understanding the story of that company. And then the third pillar is understanding if that kind of story is already priced into the stock. This is just having the right philosophical mindset of what makes a good investment. So let's dive right in with the first pillar, which is really more of an understanding. The stock price of a company is really tied to the amount of profit that company makes. Now, profit can be measured in a couple of different metrics. It can be measured as net income, earnings per share, free cash flow per share, and lots of investors like to use slightly different metrics. They're mostly variations of the same idea, and that idea is fundamentally what a company can pay back to investors in the form of a dividend. Obviously, a person is giving money to a company so that down the line, the company can give money back to the investor. Profit is the measure of that future ability of the company to pay dividends back to the investor. And so ultimately, that's what drives share prices. A person is willing to pay more for a company if that company is able to pay more back to the investor. So that really covers the first pillar, which is that fundamental understanding of what drives stock price, and that is the profit, the amount of profit the company is making. Let's move on to the second pillar. And the second pillar is understanding the company's story. So to really know if an investment is a good investment or not, you need to understand the story of that company. You need to understand what their products are, what their mission statement is, what products they're serving to the consumer. How does the consumer view that product? How is that product helping the consumer, helping solve their pain points? How is the company increasing the consumer benefit per dollar that they spend on the product? That's a great way to see ultimately which company will do the best. The best company is the company that best allocates scarce resources according to people's greatest desires. So if a company is able to, best allocate minerals, food supplies, people's times to best, fulfilling the desires of the consumer, that company is ultimately going to produce the most profit, right? Because, people have limited dollar amounts and they can only spend money on what they want the most. So if that product is what consumers want the most, they're going to spend the most, like everyone's going to be spending money on that product. So you have to understand that story, why the product is a good product, why people are going to continue buying more of that product, why more people are going to be buying that product. There's other important things to understand as well when understanding the company's story. Is it founder-led? What is the founder's vision of the company? Is the company financially stable? You don't really want to buy a super debt-laden company unless they have a really good plan of how they're going to get out of that debt. So again, it all comes back to the story. Any situation could be a good investment if you truly understand the story behind that situation. So you don't want to just discount a stock because they have a lot of debt. Maybe they have a lot of debt for a reason, because they have been doing a ton of investment in a product that is maybe they've been investing in this product for 10 years. And now that product is only a few months away from hitting the shelves. And that is truly a fundamentally revolutionary product that is going to sell hundreds of millions or billions of dollars worth of product. And the debt really doesn't mean anything anymore. So it's all relative to the story. You really have to understand the company's story. So that's the second pillar. And then finally, the third pillar is really understanding the price that you're paying for that company. So oftentimes, the amount of return you'll see is dependent on what the price you pay for the company is, right? Investing is, you make money in investing by 2 ways: buying low and selling high, or by the dividend. You have to understand what you're paying for it now and the story so that you can be confident that later you're going to be able to sell it for more. So understanding what you're paying for it now is super, super important. There's a lot of ways to understand the price that you're paying for the company. It could be the market cap. It can be the PEG ratio, which is the price to earnings to growth ratio. There's different variations of the PEG ratio where you look at the enterprise value, you look at the balance sheet, the price to book ratio, the price to sales ratio. If you don't understand any of these ratios, there's plenty of videos on the internet that you can go look up that quickly explain them. You just have to build your knowledge of being able to evaluate a company. And price is all relative. So it's relative to that story. So that's why you really have to build a great understanding of the company's story before you can truly understand if that company is expensive. Because even though the S&P 500's average PE ratio is like 24, a company with a 100 PE ratio might be a really good buy still if it's growing super, super fast or is about to be growing super, super fast. So a few examples could be, Palantir. Palantir has a 300 PE ratio or something like that. And even a few months ago, before this huge drop that we're currently in at this time, the Trump tariff drop, the Palantir's PE ratio was 500. So, that's relative to other companies looks really, really expensive. But if you truly understand Palantir's story and you understand what their product is and how fundamentally revolutionary it is, you might still want to buy some. Now, you can definitely allocate more or less of your portfolio to that based on how expensive it is. Like I wouldn't all in Palantir at a 500 PE ratio. That's a bit ridiculous. But maybe you do want to allocate, still 2, 3, 4, 5, 10% of your portfolio towards Palantir. And then if you understand the story is really good, when you see that the PE ratio drops from 500 to 300, maybe you want to bump that up from 5% to 15% of your portfolio in Palantir. If you really believe in the story. Now, I'm not necessarily endorsing Palantir. It's a stock that I personally am not invested in. My brother is invested in, but he bought it at a way lower price before it ran up. But maybe I'm considering it. And if I continue to see Palantir drop some more, I do want to buy it. Maybe I'll buy it at 200 PE ratio because I truly understand the company's story, and I think it will not only grow into that evaluation, it will greatly surpass that evaluation. Another great example of that is Tesla. So Tesla has around 140 PE ratio as of today, April 23rd. This is after Q1 earnings. And if you're just looking at their earnings from Q1, that PE ratio looks absolutely ridiculous. Their sales are declining, their revenue is declining, their profit is declining. No person in their right mind looking back would buy this company. But if you start to understand the story and you understand the massive amount of revenue unlock that they are about to open up with full self-driving, you're going, maybe Tesla's kind of cheap actually. If they have, 5 million, I don't know how many vehicles they have on the road. It's in the millions. They have millions of vehicles on the road. It's like they're building up this massive, massive body of water behind a dam. And that dam is full self-driving. And when that is finally released, that dam falls down, it doesn't matter if they sold, 10 million vehicles at a loss. Maybe they even would go into negative profit, or they're losing money. It could still be a great investment because as soon as the autonomous taxi network is released, you could have this massive earnings potential. Uber's revenue is like 44 billion. They could cannibalize all of that, and almost all of that could be pure profit because they already have the management structure. They already have their operation expenses paid for by the manufacturing part of the company, the energy sector of the company, the AI sector of that company. Those Uber rides could be far, far more profitable than Uber's taxi rides are. They don't have to pay for the driver. They don't have to pay the gas car maintenance fees. They manufacture the vehicles themselves. So even retail, the Tesla vehicle might be $25,000. Well, it costs Tesla $20,000 to make it. So their cost per vehicle is the $20,000 costs of manufacturing. So you have to understand the story. This is just some examples We'll do deeper dives into all of these kind of companies in the future on this channel. But these are really the things you need to understand what a good investment even looks like. So again, it's that fundamental understanding that stock price is tied to the earnings or the profit of the company. The second is really understanding the story, and I can't emphasize enough how important this part is. This is by far the most important pillar of these three pillars of a good investment. You have to understand the story because again, this third pillar of understanding its current price is all in, context to that story. Whether or not it is expensive or not by, those ratios, that's all relative based on what the story is. So you really have to understand that story to really understand what the price is you're paying for it and relatively whether or not that's expensive or not. So yeah, if you can really keep in mind these three pillars when you're looking at investments, you're going to make some great investments throughout your life. Maybe not every single one is going to be right because we're not going to get every story right. And this kind of investing is so dependent on the story investing. But I think even at a 60% hit ratio, which I think if you just have the basic understanding of what makes a good story is that product that people want, and you say, you're a consumer too, right? You're an average Joe. So if you look at something and go, that product would help my life, it's probably going to help other people's lives too. So it doesn't have to be this crazy, intricate, complicated story. I mean, just look at a product. Would you buy that product? Would you buy that product over other products that are in the market? And you can see that the founder has a great vision for that company. It doesn't have to be more complicated to that. And even if you're right 60% of the time, which I think you'll probably can be right far more of the time than that, you're going to have an incredible return on your investments, far outpacing the S&P 500 just by using these three basic steps. Again, these basic steps are not from me. I learned this from other people. I learned this from my brother. I learned this from Peter Lynch. I learned it by listening to other investment YouTube channels like Antonio Linares. Definitely recommend going and checking out his channel, Beating the Denominator. These are all their great resources. Go, keep learning. You have to become a student of investing in order to become really good at this. But this is the basic framework. These three pillars are the basic framework of what makes a good investment. And obviously you can increase your skill in doing these three steps. But this is just the basic high-level overview of those three steps. Thank you so much for your time. We hope you got a lot of value out of this video. We appreciate you watching, and we'll see you next time.